What's up, you guys? Welcome back to the channel. Thanks for tuning in. My name is Crass and I'm back at you with another video on investing. So guys, in this video, I'm going to be covering a lot of different risk assets that you can invest in through your brokerage account on the stock market. So without further ado, let's get right into the graph here. As you can see, we have 15 different types of investments or methods of investing. So they range from low risk, which is in the green, right up to very high risk type assets or ways of investing, which is in the red. So obviously, myself being a value oriented and diversification oriented investor, I would recommend that you guys stick away from the high risk asset classes. Okay, in most cases you're going to lose all your money if you invest in those, so that's a big red flag. That's why they're red. Stay away from that. Okay, now on the bottom axis we have return. Okay, and return is measured in percentage, and this is an annualized percentage return that you can expect, and a lot of these are based on historical averages. Okay, so for instance, if you look at number 6, which is the ETF, the exchange traded fund, on average you can expect around 10% return per year. Some years you might get 15-20%, other years you might get 5%, you might get -5%, -10%. So really guys, it goes without saying that for every single one of these asset classes you can actually get a negative return on it. Okay, now cash, let's start off with cash. It's an interesting one. All right, the fact of the matter is that if you convert all of your money into cash, literally physical cash that's not sitting in a bank account earning you interest, if you convert it into that, you are going to really suffer, and you're going to be losing money every year due to inflation. Okay, now to avoid that, you can take that cash and put it into a term deposit or a savings account, which is really only has a little bit more risk. And here in Australia, term deposits and savings accounts are backed by the government up to, I believe, $250,000 per account per bank. So even if your bank were to go bankrupt for whatever reason and you had $200,000 saved in that savings account, good old Mr. Government would pay that money straight back to you. Why? Because they control the money supply. They have the printing presses and they can produce money literally out of thin air. So Treasury index bonds and Australian government bonds, they are debt instruments that are raised by the government to raise money for their own buying purposes and stimulating the economy type purposes. And so whatever face value the bond might be worth $10,000. What that means is that over the life of the bond, you will get maybe a 2% or a 3% return per year. So if you've invested $10,000, you will get back 3% of that every year, plus the $10,000 at the end of the life of the bond if you hold it until the end. Treasury index bonds are interesting, and there's something to look into because the return on them is also based on the inflation rate. Okay, so you're never going to lose money by investing in Treasury index bonds because you're always going to be ahead of inflation. Exchange traded bonds, they attract more risk because exchange traded bonds are issued by companies, and we all know that companies, when they have consecutive quarters and consecutive years of losses, those companies cease to exist, because a company can only exist if they are making consistent profits over long periods of time. So naturally the risks behind a company increase because you are faced with large groups of people that get together for a common economic purpose to produce a product or a service. And sometimes those people are not managed well. Sometimes a competitor comes in and creates a better product, and this particular company can't make that product. So this is why from a individual company perspective, I've ranked that quite high, on the high end of the risk spectrum. And this is why an exchange traded fund, or a REIT, a real estate investment trust, or a listed investment company, or a managed fund, which is really a large basket of many different small companies. If one of those small companies were to go bankrupt or were to not make any more profits, then it's okay. It's lower risk because you still have all those other companies in that basket earning you money. And typically on an average historical basis, if you buy your typical exchange traded fund that tracks the index, you can expect an average return of about 10% per year from that fund. So moving up the risk categories, keep in mind also that a managed fund, a listed investment company, and a exchange traded fund are essentially the same thing. They're just baskets of stocks. The managed funds and the listed investment companies are run by managers who have the ability to elect which stocks they want in that basket. So based on their own analysis and opinions, they can choose stocks for that basket. An exchange traded fund merely tracks the index that it's supposed to track. And that's why it has lower fees, and that's why as well, over long periods of time, most managed funds do not outperform exchange traded funds. In fact, you're gonna be leaving a lot of money on the table if you stick with managed funds over long periods of time. Yes, there are some years where you can get very lucky and be in a managed fund that outperforms the market by 10-15%, but that is not a consistent thing. Okay, if that happened, then everybody would be piling into that one fund that beat all the other funds, and no fund can consistently beat the market. It's just a fact. Okay, unless you're Warren Buffett. If you're Warren Buffett, then that's a different story. All right. Moving up the risk categories, we have things like forex, short selling, investing with margin loans, contracts for difference, which they're actually called options in the US. And then we have things like exotic contracts such as futures and swaps. And guys, a lot of these contracts, they're created for companies for very specific purposes. A lot of these companies, they want to hedge their raw inputs into their manufacturing process, for example, or they want to hedge their currency exchanges. They might want to have a fixed price of a certain product in the future, so they use these contracts for a certain reason. Okay. From our perspective, investors that try and make money off these contracts by betting on a future price or betting on short-term movements in underlying assets, which is what you do with contracts for difference, usually they end up losing money. Okay, so I would really steer clear of these investments. I would steer clear of short selling. What I would do is I would minimize the amount of individual companies that I invest in, and I would try and maximize my investments in items 2 right up until item 8. Okay, that's what I'd be focused on, guys. Now, having said that, let's turn our attention to away from this like kind of theoretical risk return type chart to what usually happens. Okay, and what usually happens if we look at this this graphic that I've overlaid here. This line, this dotted line, is basically the expected returns for most investors. So within this curve, from the peak through from the peak at 10%, most investors, their portfolios are going to be some mixture of cash, bonds, and risky assets such as shares. Okay, and property. You can stick property. Property's probably going to be somewhere around the 7 or 8 level in terms of risk. I'm talking about residential property. Now, most investors are going to be earning somewhere between 3 to 10% over their investing careers. It is very rare for an investor to be able to consistently earn over 10% in the long run. That is very, very rare. So for most investors, I would argue that the sweet spot is somewhere around that 10% mark. So if you start dabbling in margin loans, short selling, or if you have too much cash on the flip side, if you're too heavily into cash, too heavily into gold or silver or term deposits, you're leaving a lot of money on the table in the long run because you're missing out on the productivity behind the riskier asset classes, okay? So things like bonds, there's not much productivity behind that. They are a debt instrument that's created and printed by a government. They have a limited return, in fact, a very well-defined return that they can give you. Your term deposit, a very well-defined return it can give you. With shares and exchange-traded funds, which are diversified baskets of shares, the sky is the limit, guys. So with this video, I really just wanted to highlight and show you guys where you should be. This is the whole point of this video, is to show where you should be putting your money. Keep your money away from cash. Don't have too much cash unless you're saving for a property or saving for something. That's a different story. I'm not talking about that money. I'm talking about money that you should be investing. Keep your money that you should be investing away from high risk assets. Don't put all your money into small cap mining companies or even individual companies. Okay, we've seen in the last couple of months, we've seen ASX 100 multi-billion-dollar companies lose 50% of their value. Okay, and a lot of these companies completely lose all their revenue in a matter of a week. So that's why individual companies over a long period of time are very, very high risk. Okay, very high risk. They might not appear to be, but they actually are. I'm talking 30 plus years. So over a period of 30 plus years, 30 to 50 year investment time frame, I would 100% stick to exchange traded funds. That's it. Keep it simple. Don't get too greedy, and stay focused on the fundamentals. Okay, if you're going to invest in real estate or if you're going to invest in individual companies, focus on the fundamentals. Make sure those companies have great assets, great management, and they're making cash. Okay, if you focus on those things and you stick within this kind of sweet spot here on the graph with your investments, you're going to do pretty well over a long period of time. All right, guys, if you like that video, if it's helped you, leave a like, comment, subscribe. If you guys have any questions at all, I'd be very happy to answer them. Please leave your questions in a comment below or send me a message. Okay, guys, you guys take care, and I'll see you in the next video. All right, bye.